Good morning, ladies and gentlemen. Thank you very much for giving us the honor to listen to Kommunalkredit. My name is Bernd Vislage. I'm the Chief Executive Officer of Kommunalkredit. I understand that a short investor presentation has been circulated ahead, so let me lead you through the various elements of such presentation. Page 2 gives a short overview and snapshot on Kommunalkredit's business model at a glance. The institution is focusing primarily on two segments. One is the public finance segment, where we are funding federal, states, municipalities, as well as public sector enterprises, with a focus on the German, Austria, Switzerland region, and a few investments outside in the more highly rated countries within Europe. The second business element is focusing around infrastructure energy, where we are providing quite a wide range of services from financial advisory, M&A advisory, into structuring and arranging of senior debt, mezzanine, up to export credit, enhanced financing with institutions such as Hermes in Germany, BPI in France, and similar, up to the syndication and placement of underwritten positions, and in some cases private placements or pre-placements, all the way up to our fund asset management platform on Fidelio. The bank is refinanced by a combination of customer deposits, senior unsecured issuances, and covered bonds. Moving on to effectively the business line that gives us the biggest boost in the growth of our results. Let me focus on page 3 on the long-term infrastructure energy market in Europe that is effectively benefiting from a secular trend. Since the past decade, the European market has grown from around 80 billion to more than 361 million. And again, for the first half year of 2023, with 131 billion, the market has been very resilient and almost as big as it has been in the first half year of 2022, with 137 million. And this strength of the market has been delivered despite the war in Ukraine, despite growing interest environment, and despite rallying inflation. The structural factors that, in our view, continue to boost the markets are being driven most notably by the transformation of the energy segment within Europe, which is supported by the European Union by the Green Deal. We see the reconfiguration of the EU energy mix. We have very ambitious national climate targets where we want to be carbon neutral by 2040 in Austria and 2050 across the European Union on the one hand, and on the other hand, continuously shifting demographies with the demand for higher investment in social infrastructure, reindustrialization as a response to the COVID-19 pandemic, with supply chains back into Europe, and last but not least, with a changing working and learning pattern or environment with working from home, digital teaching, and so on. The highlights of our first half-year report, in short, we have grown our net interest income by more than 50% compared to the first half year of 2022. We have grown our operating result by 31% in a year-on-year comparison, and we have delivered again, as already in the first half year of 2022, a cost-income ratio at a remarkable 41.4%, accompanied with an outstanding return on equity of 27.5% before tax and 20.8% after tax, underlying and evidencing the excellent profitability, the resilience of the business model, and the sustainable approach of ourselves to the business. Our asset quality has remained high. We have an average portfolio rating at BBB+, and we have, unfortunately, for the very first time since our privatization, a non-performing loan ratio, which is standing at 0.4% for an asset that enjoys the export credit guarantees from the Republic of Germany, which after the payments of the Hermes guarantee, the remaining NPL exposure stays at 0.03%. Our capitalization remains strong. Our Tier 1 ratio for the half year stood at 17.4%. If we move on to page 5, one of the important metrics is the growth of the loan portfolio. The loan portfolio has grown by 10%. I have highlighted previously that the infrastructure energy business has been resilient to all the economic challenges, whether it has been the war, whether it is the ongoing pandemic, whether it's inflation, whether it's high interest rate environment. We do anticipate an ongoing long-term growing demand to notably fund the energy transition, equally as the digitalization, zero-emission mobility, elderly care, as well as public health, which is pretty much evidenced by the way we have generated the new business, by the growth of our loan portfolio, and equally when we look into the funding. If we move on to the next page, you have heard me saying this as the presentation of our annual results for 2022. You have seen it in our annual report. The sustainability strategy of the bank is anchored around 3 overriding commitments. The first commitment is that by the year 2025, we want to invest annually between 40 and 50% of our new financings towards the green transition, which is a quota that we have already delivered last year and which we have delivered again in the first half year 2023. In addition, up to 10% of our new infrastructure energy business shall be going towards new green solutions, whether this is battery solutions, storage solutions, hydrogen solutions, and again, that factor that we want to achieve by the year 2025 will be achieved already in the year 2023. Last but not least, 30% of our annual investments are directed towards improving everyone's life, daily life, in a combination of fostering investments into the social infrastructure and the healthcare infrastructure, as well as into the digital and communication infrastructure. We have delivered so in the past year, and we will be seeking to deliver also here our ambitions already in the year 2023, which we have formulated for the year 2025. Moving on in terms of growth and profitability to page 7, our total income has risen by almost 30% to 97 million. Our total expenses have also been grown by close to 30% to 42 million. They reflect notably our investments into people, into expanding our business, mostly on the financial advisory side, and some of them have already yielded results. You may have seen by the German-dominated press that Kommunalkredit has undertaken the M&A advisory and the financial debt raising advisory for the acquisition of Steag by Asterion. Steag is the 5th biggest German energy producer, and this acquisition was undertaken in a 2.6 billion overall transaction. This explains part of the expenses that we have incurred. With those, as in the past, very rigorously, we have managed our cost-income ratio. It stood at 41.4% in the first half year of 2022, and despite our investments, which I would describe as investments of entrepreneurial nature, we have maintained our cost-income ratio at a remarkable 41.4%. The risk costs, not surprisingly, if you look into the past of the institutions, have remained small. The result before tax has grown by 6% to 55 million, and they are effectively a representation that in the first half year 2022, we had quite a large number of extraordinary results. We have managed to transform the extraordinary result in ongoing operating results, which then have led to return on equity after tax of 20.8%, with a CET1 ratio that slightly had increased in the year-on-year comparison from 14.7% to 15.2%. The message is our business growth drivers are intact. We keep our cost discipline extremely high. We continuously have low risk costs, and we undertake an efficient capital utilization. If we move on with this to our balance sheet, I'm very proud to represent that over the years from 2015 at the privatization till to date, we have grown our capital from 170 million to nearly 500 million. We have been very disciplined in our capital allocation by 5%. We exceed the requirements of the regulator, and the capital has been developed mostly by organic capital build-up, which means that we have not only paid attractive dividends, as you can see in the chart, but equally our investors have believed in our business model and have kept a high share of retained earnings that have further fostered and fueled the production of our result. In the context, moving on to page 9, one element always been important for an institution in addition to the risk performance is the liquidity performance. We run a remarkable almost 390% liquidity cover ratio and a net stable funding ratio of 115%, which slightly have come down given that our 3-year issuance of 21 is expiring before summer 24. Hence, it contributes to a lesser extent to the net stable funding ratio, which partially has and for the remainder will be replaced by private placements that are occurring in the second half year, which means that I would be expecting that we will be exceeding the 120 percentage mark again. Also notably, our deposit base is quite well diversified between deposits from retail customers, from corporate customers, and from municipalities. And remarkable that in those deposits we do run a very high share of term deposits with 84%. I said before, important for any financial institution is the liquidity situation. The other element is the risk situation. We continue to run a very high percentage share with 67% of investment grade rated assets on our balance sheet. The average rating is standing at BBB+. 34% of our assets are actually rated AAA and AA. The risk profile remains low. The loan book is very diversified, and you see the distribution on the right-hand side in terms of rating, in terms of region, and in terms of borrower identity. The combination of those have led in the first half year 2003 to an improvement, notably on the Standard & Poor rating from a BBB- flat to a BBB- positive outlook, which is something that is important to us to work on a continuous improvement. And we do put trust on the delivery of the first half year results that we intend to continue in the second half, that will be positively reflected by the rating agency in the action that is expected for the first half of next year. Over and above, we have worked and focused on our ESG rating. We have achieved the prime status with a very high level of transparency assigned to us. Moving on to the strong capitalization on page 12. You see both our return on equity, which stands remarkably high, and this is sustainable return on equity. It is not being driven by trading results, derivative results, or similar. And in the context of this, the continuous, the annual growth ratio of our capital position that I said before has gone close to 500 million, and that is then expressed by a Tier 1 ratio, which stands well in excess of 15%. A shareholder change is under portas. We have communicated in our annual report that a share purchase agreement has been signed with Alter for the acquisition of an 80% stake in conjunction with a 100 million capital increase once the ownership control procedure has been completed. The ownership control procedure involving the Financial Market Authority in Austria in conjunction with the European Central Bank and the Reichsbank in Sweden is progressing very well, because of which we anticipate that the process is hopefully coming to an end relatively soon and then triggering the capital injection in conjunction with a currently planned very high share of retained earnings that would boost our capital position from 500 million by more than a third in the next cycle. The capital shall be used primarily for 3 strategic initiatives. Number 1, we want to continue and not change our strategy and continue to employ our capital across the infrastructure energy range of products to grow our overall infrastructure energy business, which we continue to believe into being a sustainable, resilient, and a strong growth business case. We want to further expand and invest in people of our business lines, both on the coverage side and on the sales side, so the client business, as well as the advisory business, which has already yielded 3 successful M&A transactions in the beginning of the second half of this year, and will do so for the rest of the year. And thirdly, we will unlock further complementary business, notably not only on the M&A advisory platform, but also on the asset management platform and on our development activities, where, as you're aware, we have invested into green electrolyzer together with OMV. We have invested into solar rooftop with a regional developer in Upper Austria. The electrolyzer is in the final days of being completed and should go into operation at the turn of the year. And we have also made some progress on our rooftop solar ambitions. This all brings me to the guidance for our year-end result. I do anticipate that our total balance sheet will grow by 10% or more in a year-on-year comparison. The net interest income will jump in excess of 160 million. By this, we will deliver a return on equity after tax well in excess of 15%. And we will keep our cost-income ratio well inside 48%, maybe even inside 45%. We will face a capital increase of 100 million, and we will see a very high share of retained earnings to give us a capital boost well in excess of 150 million. By this, the CET1 ratio will be far in excess of 15%, and an average portfolio rating you should be expecting for the year end either at a level of BBB+ or maybe even A-. And the NPL ratio will stay inside 1%. The medium-term ambition is that together with our future investor Alter, we are designing the strategy for the 3 years to come. The strategy will not change the business that we are doing as per day. It will accelerate the business. It will us giving a bigger geographical reach within Europe. And hence, we are setting the ambitions not only for 2024, but the years beyond. As we stand today in our forecast, the year result of 2003 will outpace the budgeted results for the year 2024 when they were budgeted in the last year. The cornerstones of our planning is to deliver a return on equity after tax of 14% or more, a cost-income ratio well below 45%, very high retained earnings to further grow our capital up to 700 million and beyond, an average portfolio rating of BBB+, a strong capitalization with a CET1 ratio in excess of 15%, and as I mentioned before on our sustainability goals, more than 40% of our annual investments towards the green transition, 10% to innovation, 30% to improve the people's life. And with all those measurements, we are determined to improve our rating with the big rating entities. This brings me to an end. I do thank you very much for your attention, for your interest into Kommunalkredit, and I shall be very pleased if you continue to join us on the path of our growth, on the path of our access, and I hope that we do not only deserve and merit, but continue to gain the trust of your investments in Kommunalkredit, as we have delivered our share to your trust with the performance over the past 5 years since I'm running the institution as the Chief Executive Officer. Thank you very much for your attention.
We will now begin the question and answer session.
We have one question. Can we expect an ESG bond issued by Kommunalkredit?
We're in a continuous dialogue with potential lead managers for green bond, for social bond, for an ESG bond. I would be very pleased if we come to a situation where we would be issuing an ESG bond, but this is a guidance we are taking very much from the market and from a market demand. So if there is a demand available, for sure we will be working on the issuance of the ESG bond. But having said this, there's currently no plan to do so within the year 2023. So this is on the agenda for the next year. Bridging, in case you want to have further questions, what do we do in the meantime is, and we have done so recently, issuing a private placement. Given the business we are doing, and I mentioned our targets and commitments for 2025, and that we're trying to adhere to them already in this year, there is obviously private placements that are directed towards ESG investments, meeting effectively that demand. I'm looking to my colleagues whether there's any other question.
No further questions.